Thursday, May the 8th, 2025. Welcome back, everyone, to the FinWell Daily Brief.
And can you believe it? This is our 34th edition already.
I know, it feels like just yesterday we started, but here we are, 34 down.
Time really does fly when you're tracking these markets day in, day out.
Absolutely. And speaking of tracking, let's get straight into our financial fact of the day. It's quite something.
Okay, let's hear it.
As of March 2025, the total outstanding amount under the Pradhan Mantri Jan Yojana accounts, PMJDY hit 2.2 lakh crore.
Wow, 2.2 lakh crore. That's a massive number.
It really is. Just let that sink in.
And it's not just the number itself, is it? It really points to, well, a huge leap in financial inclusion.
Exactly. Think about all the people who didn't have bank accounts before.
Right. It shows a real growth in savings culture among the previously underbanked population here in India. It's foundational, really.
A great indicator to start with.
Yeah.
Okay, let's move to the markets. How did things look at the close today? It's May 8th, 3.3 GIA PM IST.
Well, it was definitely a day painted in red, you could say. A bit of a pullback.
Yeah, seems like investors were feeling cautious. Let's run through the numbers. Nifty 50 closed at 24,153.05.
That's down 261.35 points, or about 1.07%.
And it gets steeper from there, right? The big caps.
The Nifty Midcap 150 ended at $19,499.00. That's a drop of 444.65 points.
Which is 2.23% down. Quite significant.
Very significant. And small caps weren't spared either. The Nifty Small Cap 250 finished at 15,106.60.
Down 256.0 points, or 1.67%.
And even the Nifty Total Market Index, sort of the overall picture, dipped, closed at 12,198.50.
Down 188.55 points. 1.52%. So really broad-based selling today.
Absolutely. Investors pulling back from perceived risk. Now let's look at bonds and currency. What's the story there?
Okay, so the 10-year government bond yield, it's sitting at 6.45%.
And that's up from yesterday, right? May 7th. It is. Yesterday it was 6.35%, so a noticeable jump there.
Interesting. And the rupee versus the U.S. dollar?
The latest from XE Currency Converter puts it at 85.70 INR per USD.
So the rupee's weakened a bit against the dollar. What should we read into these moves? The bond yield rise, the weaker rupee?
Well, the rising bond yield, it can often signal market expectations of maybe higher inflation coming down the track, or perhaps potential interest rate hikes.
Okay, so markets pricing in future possibilities.
Exactly. And the rupee weakening, that's often a mix. Global dollar strength plays a part for sure, but also domestic factors, maybe concerns about our economy or even geopolitical stuff.
Geopolitics. That seems like a good transition into the top news stories that might be influencing this mood.
Yeah.
What's driving the headlines?
Well, first off, gold prices are surging. We're seeing reports like in the Times of India linking this directly to increased demand for safe haven assets.
Because of rising geopolitical tensions.
Precisely. When uncertainty increases globally, gold often benefits. People seek safety.
Makes sense. And speaking of tensions, the situation between India and Pakistan, that's likely weighing on minds too.
Definitely. Sources like LinkedIn highlight how these escalating concerns are, dampening investor confidence. They add to market volatility.
Understandable. Markets hate uncertainty. What about the bigger global picture? U.S.-China trade.
Yes. Investing.com notes that Asian markets had a mixed day, and a lot of that is tied to the ongoing U.S.-China trade talks. Any development there, positive or negative, sends ripples.
It really does affect global sentiment, doesn't it?
It absolutely does. And touching on the currency again, the rupee's move isn't in isolation. It reflects these global trends plus our own specific economic picture.
Right, it's interconnected. And the U.S. markets, any clear signals from there?
Still quite volatile, according to Investing.com. The S&P 500 is fluctuating. Seems like there's uncertainty from the Federal Reserve signals, plus those ongoing trade talks we mentioned.
So putting it all together, it sounds like a pretty complex mix influencing the market right now. Geopolitics, global economic jitters, domestic factors.
That sums it up well. It is complex. And that macroeconomic factor, the rising bond yield we talked about, that's definitely one for you, our listener, to keep a close eye on.
Because it hints at inflation or rate hikes.
Exactly. Watching the RBI's policy decisions and commentary will be crucial in the coming weeks and months.
Got it. Now, within this complex picture, are any specific sectors standing out, either positively or negatively?
Yes, definitely seeing some divergence. Technology, for instance, continues to show resilience.
Driven by that ongoing digital push.
Right. Digital transformation, innovation.
Right.
That engine keeps running. Also, the pharmaceutical sector looks relatively strong.
How's that?
Increasing demand, both here and globally as companies expand. Healthcare tends to be somewhat defensive.
Okay. And any sectors facing more significant headwinds?
The banking sector seems to be facing some challenges. Issues like rising NPAs, non-performing assets, and perhaps increased regulatory oversight are creating pressure.
So a mixed bag across different industries. Given all this, what's the recommended strategy for you, our listener, navigating this market?
Well, caution is certainly advisable right now. The focus should probably be on companies with really strong fundamentals.
Meaning solid financials, good track records.
Exactly. Sound balance sheets, consistent earnings, maybe a competitive advantage. And as always, diversification is key.
Don't put all your eggs in one basket.
Precisely. Spreading investments across different sectors, maybe different asset types, helps manage that overall risk, especially when things feel uncertain.
Very sound advice. Now, folks, before we move on, just a quick word. Staying informed in finance is critical, but it can feel like a lot.
It can be overwhelming sometimes.
That's why we do the FinWell Daily Brief. If you want these kinds of timely updates, these essential insights delivered clearly, make sure you subscribe. Hit that button now.
It really helps you cut through the noise.
He does. And please connect with SOS FinWell on LinkedIn. We share more in-depth discussions, expert views, and it's a great place to engage with us and other informed investors. Don't miss out. Subscribe and connect.
We'd love to see you there.
All right, now let's shift gears to something really important. Protecting yourself. We need to talk about stock market scams. Today, let's focus on the boiler room scam.
Ah, yes, the boiler room. Sounds old school, but unfortunately, these tactics persist.
So what exactly is it? How does it work?
Essentially, it involves fraudsters, often working in a high-pressure environment, hence the name boiler room. They make cold calls, unsolicited calls to potential investors.
Okay, red flag number 1, unsolicited calls.
Big red flag. And they use extremely high-pressure tactics to sell stocks that are often questionable, maybe even completely fake. They'll pretend to be brokers from some fancy-sounding firm.
Promising the moon, I imagine.
It's believable returns.
Exactly. They pitch these exclusive opportunities, often using false or misleading information to pump up the stock's price temporarily. They create this intense urgency you have to buy NW.
Making it hard for people to think clearly. So what can you do to protect yourself? First, always verify credentials. If someone calls you pitching stocks, check if they and their firm are registered with the proper regulators, like SEBI here in India.
Don't just take their word for it.
Never.
Yeah.
Second, be incredibly wary of any unsolicited investment offer, especially if it sounds too good to be true or comes with high pressure. Legitimate advisors don't usually operate that way.
Good point. What else?
Don't let anyone rush you. Take your time, do your own research. If you feel pressured, just hang up. It's your money.
Absolutely. And if you suspect something,
report it. Contact the regulatory authorities immediately. Reporting suspicious activity helps protect everyone.
Crucial advice. Always err on the side of caution with your money. So wrapping things up for today, this market dip really underscores the need for informed decisions, doesn't it?
It certainly does. It's a reminder to stay informed, be cautious, especially when markets get volatile like this.
The key is to focus on your long-term goals, right?
Yeah.
Not get swayed by the daily swings.
Exactly. Keep that long-term perspective, maintain a diversified portfolio, and try to avoid those impulsive reactions to market noise. Stay calm, stay informed.
Wise words. And speaking of wisdom, let's end with our quote of the day. This one's from the legendary Warren Buffett.
Always a good source of wisdom.
He said, "A simple rule dictates my buying. Be fearful when others are greedy, and be greedy when others are fearful."
A classic. Something to really think about in times like these.
Indeed. Mull that over, everyone. Thanks for tuning into the FinWell Daily Brief. We'll catch you next time.